Have you ever heard of a heist so audacious, so brilliantly executed, that it reads more like a Hollywood script than a real-life crime? Today, we're diving deep into the story of the Great Silver Heist, a tale involving mountains of silver, a shadowy mastermind, and a mystery that baffled investigators for years. It all begins with the Hunt brothers, Nelson and Herbert. These weren't your average billionaires. They were the sons of Texas oil tycoon H.L. Hunt, one of the richest men in the world. Inheriting their father's fortune and his penchant for high-stakes gambles, the Hunt brothers set their sights on a commodity they believed was massively undervalued: silver. In the late 1970s, the world was in turmoil. Economic instability, the oil crisis, and rampant inflation had people scrambling for safe haven assets. The Hunts saw an opportunity. They believed that paper money was losing its value and the precious metals, especially silver, were the future. So, they started buying. And they didn't just buy a little, they bought a lot. Their strategy was aggressive and unprecedented. They weren't just buying physical silver bars. They were leveraging the futures market, buying contracts for massive amounts of silver to be delivered in the future. By doing this, they could control a staggering amount of the world's silver supply with a fraction of the capital. They teamed up with wealthy Saudi Arabian business partners, amplifying their buying power to astronomical levels. As they bought, the price of silver began to climb. It started at around $6 an ounce in early 1979. By the end of the year, it was soaring past $30. The market was in a frenzy. Everyone wanted a piece of the action. Jewelers were melting down silverware. People were rummaging through their attics for old coins, all trying to cash in on the silver rush. The Hunt brothers were at the center of it all, becoming the kings of the silver market. At their peak, it is estimated they controlled over 100 million ounces of physical silver and futures contracts for another 200 million. That was more than half of the entire world's deliverable supply. They weren't just playing the market, they were the market. This created a massive problem. Industrial users of silver, like photographic film companies Kodak and Fuji, suddenly found their costs skyrocketing. They couldn't get the silver they needed to run their businesses. Tiffany & Co., the famous jewelry company, even took out a full-page ad in the New York Times, condemning the Hunts and accusing them of trying to corner the market. They said, "We think it is unconscionable for anyone to hoard several $billion worth of silver, and thus drive the price up so high that others must pay artificially high prices for products." The commodity exchanges and federal regulators were getting nervous. The situation was spiraling out of control. A market corner, where one entity controls so much of a commodity that they can dictate the price, is illegal and dangerous. It threatened to destabilize the entire financial system. So, they decided to fight back. The regulators and the board of the COMEX, the New York Commodities Exchange, came up with a plan. They introduced a series of rule changes specifically designed to stop the Hunts. First, they placed limits on how many futures contracts any single person or group could own. But the Hunts just shifted their positions to different exchanges. So the regulators got serious. On January 21, 1980, the COMEX announced Silver Rule 7. This rule was the kill switch. It restricted trading to liquidation only. This meant that traders could only sell their existing futures contracts. They couldn't buy new ones. The door to the silver casino had just been slammed shut. For the Hunt brothers, this was a catastrophe. Their entire strategy relied on being able to keep buying or rolling over their futures contracts. Now, they were trapped, with no new buyers coming in and everyone forced to sell. There was only one direction the price could go: down. And down it went. The silver market collapsed in spectacular fashion. The day this all came to a head is now infamously known as Silver Thursday. It was March 27, 1980. The price of silver, which had peaked at over $50 an ounce just 2 months earlier, plummeted to below $11. The Hunts faced a margin call for $100 million that they simply couldn't meet. A margin call is a demand from a broker to add more money to your account to cover potential losses. When they failed to pay, their brokers started dumping their silver holdings onto the market to cover their debts, which pushed the price down even further. It was a death spiral. The panic wasn't contained to the silver market. It threatened to bring down the entire financial system. The brokerage firms that had lent the Hunts billions were on the verge of collapse. If they went under, it could trigger a domino effect, taking banks and other financial institutions with them. The chairman of the Federal Reserve at the time, Paul Volcker, later said it was one of the most perilous moments he faced during his tenure. To prevent a full-blown financial meltdown, a consortium of banks had to step in and provide a massive $1.1 billion rescue loan to the Hunt brothers. This allowed them to pay off their debts and prevented a chain reaction of defaults. But for the Hunts, the game was over. In the aftermath, they were ruined. They were dragged before congressional hearings, faced lawsuits, and were hit with massive fines by regulators. In 1988, they were convicted of conspiring to corner the silver market. They declared bankruptcy. Their vast fortune obliterated. The brothers who had once tried to take over the world as silver supply ended up selling off personal assets, including family heirlooms and even a diamond-studded water pistol, just to pay their debts. So, was it a heist? The regulators certainly thought so. They saw it as a deliberate, illegal attempt to manipulate a global market for personal gain. The Hunts, however, always maintained their innocence. They claimed they weren't trying to corner the market. They were just trying to protect their wealth from inflation, believing in the long-term value of silver. They saw themselves as victims of a system that changed the rules in the middle of the game. The story of the Great Silver Heist is a powerful cautionary tale. It's a story about greed, ambition, and the dangerous line between a bold investment and market manipulation. It shows how quickly fortunes can be made and lost, and how the actions of a few can threaten to bring down an entire economic system. The Hunt brothers reached for the sun, and for a brief, shining moment, they almost grasped it. But in the end, they were burned, leaving behind one of the most incredible and chaotic chapters in modern financial history. What do you think? Were the Hunt brothers brilliant investors who were unfairly targeted? Or were they reckless gamblers who got what they deserved? Let me know your thoughts down in the comments. Thanks for watching, and if you enjoyed this dive into financial history, don't forget to like this video and subscribe for more stories like this one. See you next time. What if I told you there's a financial crime, a massive one, that's already written into law and set to happen in just a couple of years? It's not some shadowy conspiracy theory. It has a real event with a name that sounds like it, as straight out of a history book, the silver crime of 2026. But what exactly is it, and how can it affect you, your savings, and the global economy? Stick with me, because we're about to dive deep into a story that involves presidents, global currencies, and the future of your money. To understand the silver crime of 2026, we need to travel back in time, not to 2026, but all the way back to the 19th century. Picture this: America is a young, booming nation. The currency system is based on something called bimetallism. That's a fancy word, but it just means that both gold and silver were legal tender. You could walk into a bank with a certain amount of silver and have it minted into coins, or exchange your paper dollars for a fixed amount of silver or gold. This kept the value of money tied to something real, something tangible. The Coinage Act of 1792 officially established this system, setting a fixed ratio of 15 parts silver to 1 part gold. For decades, this system worked. It fueled expansion, trade, and the growth of a new world power. Silver wasn't just a shiny metal. It was the backbone of the economy, the money of the people. But then, things started to change. The late 1800s saw huge political and economic battles over this very issue. On one side, you had the Silverites, mostly farmers and working-class people, who wanted to keep silver as money. More money in circulation meant it was easier for them to pay off their debts. On the other side were the gold bugs, the bankers, the industrialists, the East Coast elite. They wanted to move to a strict gold standard. Why? Because a gold-backed currency was seen as more stable, more sound, and it protected the value of their wealth and their loans. This wasn't just an economic debate, it was a culture war. The turning point came in 1873. With very little public debate or fanfare, Congress passed a new coinage act. At first, it seemed like a routine piece of legislation, just updating the nation's minting laws. But hidden within its pages was a critical change. It quietly ended the right of silver holders to have their metal minted into legal tender dollar coins. It effectively demonetized silver, pushing the United States closer to a gold-only standard. When the public, especially those in the silver mining West and the indebted South, realized what had happened, they were furious. So, how does a crime from 1873 connect to 2026? Here's where it gets really interesting. For most of the 20th century, silver's monetary role was gone, but it never lost its status as a precious metal and a store of value. And some coins, minted by governments around the world, still carried a special status. Let's fast forward to today and talk about the American Silver Eagle. If you've ever bought silver, you know this coin. It's the official silver bullion coin of the United States. First released in 1986, each coin contains 1 troy ounce of 99.9% pure silver. But here's the crucial part. It's not just a piece of silver. Stamped right on the coin are the words $1. This gives it a legal tender face value of $1. Now, obviously, no one is spending their silver eagle for $1 at the grocery store when the silver inside it is worth, say, $30 or more. The market value of the silver has always been much higher than its face value. So what's the point of that $1 stamp? It's a legal designation. It classifies the coin as money, not just a commodity. This distinction has huge implications, especially when it comes to taxes. For decades, this legal status has provided certain advantages. Because it's technically money, the rules around buying, selling, and reporting can be different from, say, trading stocks or other collectibles. It exists in a unique gray area, but that's all about to change. Enter the legislation that sets the stage for our modern crime. Tucked away in the massive Infrastructure Investment and Jobs Act of 2021 was a provision that many people missed, specifically Section 80,603 of the bill. This section amends the tax code, and it's a doozy. It expands the definition of a broker to include almost anyone involved in facilitating digital asset transactions. And more importantly, it changes the reporting requirements for those brokers. Starting in the tax year 2024, with reports due in 2025 and becoming fully enforced for transactions in 2026, these new rules are set to take effect. The law reclassifies certain assets, including precious metals, and subjects them to the same kind of strict reporting requirements that stocks and bonds face. So, what does this mean for the American Silver Eagle and other similar coins? It means that the government is essentially stripping away its special monetary status for tax purposes. The $1 face value will become legally irrelevant in this context. Starting in 2026, when you sell your silver coins through a dealer, the transaction will be automatically reported to the IRS. The government will treat the sale just like selling a stock. They will know how much you bought it for, how much you sold it for, and they will expect you to pay capital gains tax on the profit. The privacy and relative simplicity that long-term precious metals holders have enjoyed is set to evaporate. This is what people are calling the silver crime of 2026. It's an echo of the crime of '73. Back then, the government demonetized silver by refusing to mint it. Now, they are effectively demonetizing it for tax purposes by ignoring its face value and reclassifying it as a security or commodity subject to invasive surveillance. Just like in 1873, this change was buried in a massive, unrelated bill. And just like in 1873, it benefits the established financial system at the expense of the individual saver. By making it more difficult and less private to hold and transact in physical precious metals, it pushes people back towards the digital, centrally controlled financial system. A system where every transaction is tracked, traced, and taxed. Why would they do this? The official reason is to close the tax gap, to make sure the government gets every penny of tax revenue it believes it has owed. The government estimates it can raise billions by cracking down on unreported gains from assets like precious metals and cryptocurrencies. But there's a bigger picture here. We're moving towards a world of central bank digital currencies, or CBDCs. A CBDC is a digital version of a country's currency, issued and controlled by the central bank. It offers the government an unprecedented level of control over your money. They could track every single purchase, and even program the money to have expiration dates or restrictions on what you can buy. In a world like that, physical assets like gold and silver are a threat. They are anonymous. They are decentralized. They are outside of the digital control grid. So, it makes perfect sense that governments would want to make holding these assets less attractive. By imposing strict reporting requirements, they add a layer of friction and remove the privacy that makes physical metal so appealing. As a hedge against government overreach, it has a subtle but powerful way to herd people away from financial independence and towards financial dependence on the state-controlled system. So, what are the real-world consequences for you? If you own silver or are thinking about buying it, you need to be aware of these changes. The era of buying and selling with a high degree of privacy is coming to an end. Every transaction above a certain threshold, likely as low as $600, will be on the government's radar. This means more paperwork, more complexity, and a direct tax liability on your gains. For some, this might be a reason to sell before the rules fully kick in. For others, it might be a reason to hold on even tighter, recognizing that this government action is a sign that they are on the right track. That physical metal is indeed a powerful tool for preserving wealth outside the system. This isn't just about silver. It's part of a much larger trend. It's about the erosion of financial privacy. It's about the battle between centralized control and individual freedom. The silver crime of 2026 is a quiet, legislative move, not a loud, dramatic heist. But its impact on your ability to protect your wealth and privacy could be just as profound. Understanding this history, from the crime of '73 to the legislation of today, is the first step in navigating the financial landscape of tomorrow. It's a reminder that sometimes the biggest threats to your wealth don't come from a market crash, but from the stroke of a pen in a government building. Thanks for watching. If you found this breakdown valuable, make sure to hit the like button and subscribe for more deep dives into the financial shifts that are shaping our world. Let me know your thoughts on this in the comments below. Stay informed and stay prepared.